Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kinetic Development Group Limited annual report. Kinetic Development Group Limited offers a diverse range of businesses and services. At its core, the company engages in coal extraction and sale in China, with a focus on developing its Dafanpu coal mine. Beyond coal production, the company provides various related activities such as trading, washing, loading, and transportation. In addition to coal-related services, Kinetic Development Group Limited offers several other businesses. These include the sale and trading of mineral products, breeding and selling of livestock, and producing and selling wine and fruit wine. The company also engages in real estate development and sales, property management, engineering construction, and manufacturing of tobacco products. Furthermore, Kinetic Development Group Limited has expanded into e-commerce with the development, production, and sale of e-vapor products. This diversification into various sectors reflects the company's ambition to establish itself as a multifaceted business entity in China. Kinetic Development Group Limited maintains a market capitalization of $18 billion, broadly in line with the industry peer group. Kinetic Development Group Limited trades at a higher price-to-earnings ratio of 18 times and a higher price-to-book ratio of 1.92 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 36% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.21%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in a company are multifaceted and can be influenced by various factors. On the growth side, the commencement of production from new mines and overseas projects has significantly contributed to revenue expansion. The acquisition of Qinhuangdao Jifu and Seedlife has also enabled the establishment of additional revenue streams. Furthermore, the development of comprehensive network coverage at the Dafanpu coal mine and the introduction of high-quality coal products have enhanced service quality and increased revenue. In addition, effective supply chain management, green mine construction, and compliance with environmental regulations have all contributed to revenue growth. The business expansion into new markets, such as Cambodia, has also been a significant driver of revenue growth. On the other hand, the primary drivers of revenue decline include downward trends in market coal prices, decreased sales volume due to reduced demand, and increased costs of sales. The company's financial performance is also influenced by its accounting policies, including the recognition of sales of goods, property management services, property development and sales contracts, and interest income. These factors demonstrate that revenue growth or decline can be driven by a combination of operational, market, and financial factors. The net income of the company experienced a significant decline of 34.8% over the period, dropping from RMB 3,123.2 million to RMB 12,030.3 million, and further down to RMB 899.4 million. This substantial decrease in net income can be attributed to various factors. One major reason for this decline is the decrease in gross profit margin, which fell from 38.4% to an unspecified percentage. The company's operating costs rose, particularly at Yang'an Coal Mine, contributing to the decline in profitability. Additionally, coal prices plummeted, resulting in lower revenue from the coal mining business. The net profit margins also suffered a significant drop, decreasing from 55.2% to 38.4% and further down to 16.8%. This substantial decrease in net profit margins indicates that the company's ability to generate profits from its sales has been severely impacted by the aforementioned factors. The company's financial performance is a crucial aspect of its overall health. A key indicator of this is the generation of positive operating cash flow, which suggests that the business is able to cover its expenses and invest in growth initiatives without relying on external financing. Fortunately, there are multiple sources within the extracted summaries that confirm the company's ability to generate positive operating cash flow. On page 24, it is explicitly stated that the company has achieved this milestone. Similarly, pages 122 and 123 provide further evidence of the company's financial stability, with calculations indicating a strong operating cash flow. Additionally, pages 189 and 186 offer supporting information, although some ambiguity exists regarding the clarity of these findings. Despite these minor discrepancies, the overall picture suggests that the company is indeed generating positive operating cash flow, which is a promising sign for its future prospects. The company's debt level has undergone significant changes over the past year. While total bank loans have decreased slightly, the non-current portion of bank loans has increased substantially, indicating a shift towards longer-term borrowing. The net debt has also risen from 2.9% to 8.8%, suggesting an increase in overall indebtedness. In terms of interest expenses, there is evidence of a decrease. Interest paid in 2025 was RMB 44,018, down from RMB 47,514 in 2024, representing a reduction of 7%. Furthermore, interest expenses decreased by 9.3% from RMB 47,767 to RMB 43,405 over the same period. Overall, while there are mixed signals regarding the company's debt level, the data suggests that interest expenses have decreased significantly in recent years. The company's performance across various segments and regions has been mixed, with some areas showing significant decline. The coal mining segment has struggled due to increased costs, including interest income and finance costs, as well as higher depreciation and amortization expenses. This segment's poor performance is a major concern for the company. In addition to the coal mining segment, the other segment also experienced a decline in profit before taxation, increasing its loss from RMB 144,776 in 2024 to RMB 164,740 in 2025. On a broader scale, reportable segment revenue decreased by 17.9% across all regions and countries between 2024 and 2025. It's worth noting that the real estate and property management segment has shown some resilience, with an increase in revenue from external customers. However, this positive trend is not enough to offset the significant decline seen in other areas of the company. Overall, the company faces challenges in several key segments and regions, which will require attention and improvement efforts to address. Management is emphasizing the importance of strengthening the company's liquidity position by shifting from short-term to long-term borrowings. This move aims to improve financial stability and reduce reliance on temporary funding sources. In terms of strategy, management is prioritizing investments in capital expenditures, including the acquisition and construction of new coal mines. This expansion is expected to drive growth and increase production capacity. Additionally, the company is focusing on supply chain management to achieve mutual benefits with its partners. Safety and sustainability are also key areas of focus for management. The company is prioritizing safe production and occupational health, as well as promoting low-carbon technology transformation and exploring energy-efficient technologies. Furthermore, management is committed to strengthening sustainable management of natural resources and reducing pollutant emissions. Management is also discussing the importance of investing in research and development (R&D) to drive technological innovation. This includes enhancing employee accountability through standardized management protocols and improving coal quality management throughout the process. Overall, the company's strategy appears to be centered around growth, sustainability, and safety. The company has a history of paying dividends to its shareholders. According to the provided information, the company paid dividends in both 2024 and 2025. In 2024, the amount paid was RMB 1,228,416, while in 2025 it was RMB 854,576. The company also recognizes final dividends as a liability, indicating that they are committed to paying out these funds to shareholders. In addition to paying dividends, the company has also made provisions for future dividend payments. As of December 31, 2025, there were RM 153,806 in dividends payable. This suggests that the company is continuing to prioritize dividend payments and is making arrangements to ensure that they are paid out to shareholders as required. Overall, the company's history of paying dividends and its ongoing commitment to doing so indicates a strong focus on returning value to its shareholders. Concerns about inventory buildup or supply chain disruption. The financial reports reveal some red flags regarding inventory buildup and potential supply chain disruptions. On page 113, a significant write-down of RM 117,113,000 was recorded due to net realizable value assessment, indicating an overstocking issue. Furthermore, on page 170, the inventory value increased by 43%, while write-downs decreased by 207%. This suggests that the company may be struggling with managing its inventory levels effectively. Additionally, on page 177, it is mentioned that the acquisition of subsidiaries led to increased inventory costs. While there is no explicit mention of supply chain disruption in the provided text, these inventory-related issues could potentially have a ripple effect and impact the overall supply chain efficiency. That concludes the financial summary for Kinetic Development Group Limited. Feel free to comment below, and I will be happy to answer them when possible.